Hello and good afternoon, everyone. We'd like to welcome everyone onto this Q1 2022 Business Benchmarking and Trends event today. It's great to see so many attending. So if anyone has any technical issues, feel free to contact us using the chat function. And we will also be having a question and answer session towards the end of the event. So please feel free to post your questions in the Q&A box as we go through, and we'll pick these up and address them later. So also on the panel this afternoon, we've got Joe Brewer, who is one of our senior consulting partners here at Oldfield with many years experience. Hello, Joe.
Yeah, hello, thank you for joining.
So for the last 2 years, we've been talking about unprecedented times, and it's still true today. Yes, there's challenges, yes, there's uncertainties, but I guess there's also opportunities. But what we often find when we speak to business owners is they want to know how other businesses are doing. You see, the question might come up, when we're looking at the financials, for example, is this number good or is it bad compared to other businesses? I guess first and foremost, the concept of benchmarking allows businesses to learn from one another and obviously make better decisions. Obviously, you can evaluate your performance against others, and that means that you can drive improvements in your business. So this afternoon, to help you with that, we're going to share with you some key insights as to how our clients are actually performing. And we'll take a look at some of the trends and impacts experienced in Q1 of this year. So we'll cover some key trends on the stock. We'll cover a look at understanding the gross profit and the trends on that. We'd also like to go over the concept of working capital cost and how that's been trending over recent periods. And then we'll obviously wrap up with the question and answer session. So over to you, Joe.
Good, thank you, Angus. And it's great to see so many on the webinar this afternoon. So as Angus has already said, we wanted to share some insights and benchmark reports based on the data we are seeing coming through from our clients for the first quarter of 2022. So that's the 3 months ended 31st of March 2022. I wanted to share some of the key trends in profitability and working capital that are current in businesses today. So to clarify, there's no data in these figures for service-based businesses, but they do include elements of manufacturing, importing, wholesaling, and also project-based businesses. It's all in the mix. So the first quarter of 2022 has seen some buoyant trade going on, some very pleasing results amongst our clients in terms of revenue and profit. Average sales growth for Q1 2022 against the same quarter last year is around 17%. So a 17% uplift in sales in Q1 2022 is a really pleasing result. Obviously, some of that would be down to price increases coming through, but nevertheless, it's a very encouraging result. Also, average EBITDA up by 9% on the same quarter last year. So a special thanks to our clients and also to the team at Oldfield for that we've access to this data so quickly after the quarter end, finding our clients are increasingly up to date, and we're working with our clients to improve their internal accounting expertise, and also the team at Oldfield to pull together the accurate on-time management reports in a quick and timely manner. So there's some really up-to-date data available here, which is good. First benchmark we wanted to show looks at trading stock, or otherwise known as inventory. So if you concentrate on the grey shaded area to begin with on this graph that's showing on the slide, this shows the actual pounds value of the stock in hand in businesses, and you can see immediately that businesses are increasing their stock holding for numbers of reasons, obviously to ensure availability, to protect against supply chain delays, to fuel the increasing sales as sales sort of get back to normal, and indeed, obviously, increased trade ensues after the pandemic. Obviously, also to beat inflation, so some are stocking up to beat price increases coming through, be a step ahead of that. Then price increases of raw material do obviously account for some of the increase. So the grey area there is the actual pounds value. If you look across, you can see over the last 2 years, increasing stock value going from about 500,000 on average per business up to an average stock value now over 800,000. Obviously, that's across a broad range of different companies. So that's an increase on average of 60% in stock holding over the last 2 years. If you look at Q1 2022 in isolation, you can see that that alone there's an increase of 14% just in the one quarter. So quite an interesting trend there. And interestingly, many businesses still have spare cash at present. Sometimes that would be due to taking advantage of CBILS loans, bounce back loans, but also it's a result of surplus profit from the last couple of years. It's good to see businesses using their liquidity to invest in saleable stock. So in terms of stock days, that's the dark blue line on the graph. The definition of stock days actually is just the average length of time that stock, you might say, sits on the shelf in a business. So that's the definition of it. But you can see that businesses started to experience stock shortages in Q3 and 4 of 2020, dipping down to in the region of 60 days worth of stock at that point. And then many made a conscious decision to increase stock for the reasons we've already mentioned, supply chain issues and so on, and pulling that back up throughout 2021 up to more like an average of about 80 days worth of stock. Obviously, you've got some big variations there in businesses, but on average, 80 days worth of stock. So some businesses are still experiencing pressure in this area, struggling to overcome supply chain shortages. As we head into 2022, I think the slide shows that there's pressures going on in that area. Some businesses are struggling to maintain their levels of stock. And the pressure intensifies, of course, as sales get up to normal levels and beyond. That actually puts even more pressure on that metric. So the purple line on the graph there is the rolling average of stock days, and that, whilst that's somewhat distorted in the first couple of quarters, you can see on there that was right in the middle of the pandemic, and obviously sales were low, therefore that's a little bit distorted. You can see from the end of 2020 and onwards, the general trend is an increase in the amount of stock and the number of stock days that are held. The next reports I want to share are about gross profit and contribution margin. However, before we actually launch into those graphs, we thought it was good to just unravel, maybe elucidate those two terms, the concept of contribution margin and gross profit. So to do this, we've prepared this simple illustration so that everyone on the call can be fully conversant with what those terms mean. So if you look at the slide there, I'll just talk through that briefly. Obviously, you've got sales at the top there, and then you've got a calculation of contribution margin, which is opening stock plus purchases of goods, raw material and so on. You've got carriage inwards import duty, and then you adjust those numbers for closing stock to give a cost of goods sold. You can see there on the slide £500,000, which is 50% of the sales value. So cost of goods sold is 50%. That leaves you with a contribution margin of £500,000, and that's 50% contribution margin. However, that is where some businesses stop, if you like, in calculating GP. It's not GP, it's actually contribution margin. So we need to go a bit further and build in some other direct costs. Now, some direct costs are fixed, some variable. We can run through these. We've got carriage outwards and delivery, you can see there on the screen. Storage costs, 3PL costs. We've also got direct wages where you've got warehouse labour, drivers, and maybe some manufacturing labour, some processes going on. You might bring in some external labour there, agency or subcontract labour. There's also power and fuel there for obviously processes and warehouse costs and also deliveries, etc. And then you've got the rent and rates. If you're in a manufacturing business, that'll be your manufacturing area. You've got to actually finance the rent and rates for that. In a warehousing situation, it would be the rent and rates for the warehouse. So by the time you've factored in all of those costs, you can see we've then got a direct costs percentage of 15%, 150,000, 15% of the million. Very important to track these percentages. So your cost of goods sold is 50%, your direct costs are 15%, and that leaves you with a true gross profit of 35% after all of those direct costs. So we thought it was just good to give a little bit of education on the trading account. This is what we call a trading account, and this is before any overheads come into play at all. This is just an analysis of our true gross profit. So with that in mind, and a fresh understanding of contribution margin and GP, we head into the next report, which shows the trends on those two metrics. The top blue line shows the contribution margin, and there's nothing major to report on that really. Maybe some declines over those early quarters, then some increases for quarter one 2021 as businesses reacted and started to put prices up. And also again in quarter one 2022, the same would apply. In the main, therefore, businesses appear to have kept pace with increases from suppliers. The increase in cost of raw material and higher inbound shipping costs. We'll all be aware of the huge spike in the price of containers, particularly from the Far East. It appears that businesses have kept pace with that and also passed those increased costs on to their customers. However, when you come to the second line down, that is the true GP, after direct costs, that's shown a decline over the last 8 quarters. So that's very interesting that actually the increasing cost of fuel, freight, energy, labour, carriers, and also storage, it's all taken a toll on the true GP, and the average GP has fallen from 37% across all clients down to 34% in quarter one 2022. So that's a full 3% drop, full 3-point drop in GP, which is quite substantial. And as you can see, that is pretty consistent right across there, that there's businesses have been fighting to kind of claw back GP but haven't really succeeded. So what does that really tell us? I think one thing to point out is that tracking the direct cost element is key there. So the direct costs as a percentage of sales, if you remember on the example we looked at, were 15%, that was hypothetical. In reality, direct costs were 10% in the early quarters of 2020, and they've now risen to 13% for quarter one 2022. So be aware of that. Those direct costs that we've gone over already, that's where the increase in cost has come in. So what do we learn from that? Well, for me, for business owners, it would be to get away from a cost plus basis of selling prices, no longer on a cost plus basis, of pricing based on the product alone. That would be easy to do, the cost of the product plus so many percent to get your markup and consequently your GP. I think we've got to get away from that, and we've got to build in those extra costs such as storage, freight, labour, energy, fuel, and so on to combat that margin slippage. So just remember that it's more than just the landed cost of the product. It's actually all of those other costs have got to be built into the sale price. Obviously, being aware of what the market will stand in selling price is key to pitch your price based on what the market will stand, and also the concept of value pricing. Don't just do a cost plus. Think of the value of your product and actually your USPs, what it's going to do for the customer, the outcomes for the customer, and market those and then pitch your price based on that rather than cost plus. So hopefully that's a bit of an insight there into what's going on, particularly in terms of contribution margin and gross profit. And now I'll hand over to Angus to explain you might say, the inner workings of working capital cost and also net variable cash flow. Over to you, Angus.
Yeah, thanks, Joe. Yeah, no, that's really interesting, isn't it, to see those trends and to see that actually, we need to be tracking all those elements of our true gross profit to really ensure that we're not eroding our margins. So I think that's really enlightening to see those figures. So I guess then off the back of that, and we've seen in relationship with the stock side of things as well, this brings us on then to looking at the working capital. So the working capital cost that we refer to here is really like the cash cost of growing a business. And it relates to the length of time that cash is tied up in working capital, for example, stock and debtors. Now, this can be expressed as a number of days or as a percentage of sales. And today we'd like to just look at this as a percentage and see how that works. So how do we work out this working capital cost percentage in our business? Well, the way we work it out is showing on the screen here. So we take our value of our stock, we add in our value of our trade debtors, and then we deduct our trade creditors value. And we then take that figure and divide that by our annual sales. And that then gives us a percentage. So that gives us like a working capital cost percentage. So out of all of our sales, effectively what's tied up in stock and debtors less our creditors. Now, with that in mind, then what's actually happened to this for clients? I suppose we've been thinking that this has had an impact with the current situation. So on this report we're showing on screen here, we're really focusing on this pale blue line that kind of starts off at the bottom there and rises here. So interestingly, over the last 8 quarters, we've seen a bit of a mix on this in terms of our working capital cost. It declined a little bit in 2020. I guess that probably relates to the fact that perhaps it was struggling to get the stock holdings versus what we're trying to do may not have been there. But then we've seen that increase uptick over the course of 2021, and then now starting to see an actual slight reduction there as we go into Q1 of this year. I guess that's partly due to businesses stocking up during 2021 and now actually selling the stuff that they stocked up on. But there's other elements to it. It's not just the stock. I guess the other element to it is our debtors. And our data that we've got for Q1 2022 does show that there has actually been a marginal improvement on the rate of debt collection for Q1 2022. So that's encouraging. Although we have seen a little bit of pressure on the supplier payment terms. So that's kind of something that we need to work on. But I think this report is quite interesting to note, really, because I must admit that myself personally, I had a concern that people's working capital was bloating up, you might say, and soaking up cash over the recent times. And it's the key thing, as we've said, in relation to stock, is just make sure it's saleable stock and you can turn it into cash. So in that situation, use your surplus cash, use your liquidity to your advantage. But I guess you just need to make sure you think about the long-term effect of your strategy you're going on, and just think about those long-term supply relationships you're perhaps signing up, or those customer deals, and just make sure that they aren't, impacting your working capital cost percentage. Okay, so you could actually evaluate a particular opportunity and actually work out what the working capital cost percentage would be in that situation. And also, don't forget that if we take our eyes off this in the long term, then we could be actually impacting our business value. I think many people tend to just forget that our working capital cost, if that increases, then we can be impacting our business value. So that's a working capital cost. Now, the other element that links with this is this concept of net variable cash flow, which might sound a bit of a mouthful, but in essence, really what it's really saying is it's a measure of the additional cash that will either be generated or used by the next, £100 worth of products that the business sells. So if the net variable cash flow is positive, then for every additional £100 of revenue that the business makes, make a sale of £100. If its net variable cash flow is positive, then the business will generate cash. Obviously, conversely, if that net variable cash flow is negative, then every sale we make will actually require additional cash funding. So this is quite an interesting concept that every business really should be monitoring. And to work this out, what we need to do is obviously take our gross profit percentage. So this is our true gross profit percentage, like we looked at earlier on, after all our direct costs. And then we deduct our working capital cost that we've just looked at. And that gives you the difference. That gives you our net variable cash flow, which is like your margin of safety. And the key thing is that you've got a decent margin between your gross profit and then your working capital cost. Therefore, you've got a healthy net variable cash flow, which is the gap in between. And normally we recommend between 10 and 20%. And if you're in that region of 10 to 20%, then your business should be generating some cash, all of the things being equal. So the dark blue line on this screen is really showing, you might say, the correlation between our gross profit and our working capital, and that giving us our net variable cash flow and what that's been doing for clients. And you can see there that that's actually been declining a little bit in recent times. Has seen a bit of improvement in Q1 2022, and obviously overall for our clients, you can see there we talked about between 10 and 20%, and most businesses are actually achieving a good healthy net variable cash flow, the ones that we work with. So I think that's just another, you might say, a metric that we can track and monitor. Now, we've talked about some of these key measures, and I suppose looking back at the gross profit side of things, you might say, are we reporting? I like to raise two challenges with everyone on the call today. Are you reporting true gross profit regularly and accurately? So not just that gross profit on the contribution margin, but the true gross profit. And are you tracking your direct costs regularly and accurately? Okay, so that's what we need to be actually tracking that and reporting on that. So I think one thing that occurred to me, obviously looking at this information and seeing that slippage in our true gross profit, is that I guess as business owners we can think about our dashboards and what comes out of our CRM or ERP system and look at our margins on there. Now, we may not have seen too much of an impact, and looking at the graph earlier in our contribution margin, overall that's not showing huge concerns. Therefore, we may not have really thought too much else. However, we need to realise that it's not just what our dashboards are showing us about our margin. We need to realise what our true gross profit is, and you need to have on-time management reports, which I guess need to be prepared by experienced management accountants, which could be obviously in-house or externally, that really has a handle on getting those extra direct costs showing in your figures. built in, accounted for, and then you can use those as reports to monitor those, and you can discuss that every month. And obviously, it's key then to take action where necessary. We need to actually use the numbers to drive our business and make those changes so that we don't settle for that margin slippage. We're actually taking action in order to get our profitability back on track. And of course, on our direct cost and those different elements like our storage, like our labour, like our other direct costs, we can actually set budgets for those, and then obviously you can track and see how you're panning out against them. So I guess we can't emphasize enough the importance of it really in the accurate on-time management accounts. And it will improve. We've seen it many times that by having that rhythm of reporting and reporting it accurately in relation to those aspects, you will improve your margins, your profitability, and also you can track your working capital costs and your cash flow generation. So just before we move on to the question and answer session, I guess these key trends are really helpful for businesses to benchmark themselves against, and I hope you find this helpful to see what other businesses are doing. And I guess you can take that back and ensure you review the opportunities you have to improve. Now, just quickly, our next event is in relation to the increase in corporation tax to 25%. So just quickly, briefly mention this. Corporation tax is going up to 25% next year. We'll be sharing some strategies coming up in relation to the preparations that you can take to prepare for this. So please join us on Thursday, the 19th of May, and we'll share those with you. The key takeaways for today in relation to what we've gone over. So first one is to use spare cash to invest in good saleable trading stock. So if you're in a position where you've got surplus cash and it's safe to do so, and it's good stock, then go for it, invest in it, make the most of the opportunities to get your margins. Make sure you understand your contribution margin and your gross profit to make sure there's those two elements that you're absolutely clear on. And then make sure your selling price, as Joe mentioned earlier, allows for those direct costs such as duty, freight, labour, energy, fuel, etc. Make sure they're all built into your selling price. It's very key. And then the fourth point there is understand your working capital cost and then your net cash flow, and make sure you have a target of that of 10%. And then finally, review your monthly management reporting and ensure that you've got those elements in there and you're actually tracking your direct costs so that you can monitor your slippage and correct that. So, you might be feeling like you need more help in some of these areas that we've talked about today. Well, I guess it's a journey that every business goes on. There's a couple of solutions that we could perhaps look at to help with this, to help your business really move forward and really move the dial in increasing our GP and cash generation. And the first one obviously is the regular monthly management reports, and it's a really important component of driving your business forward. And as I said, can't really emphasize that enough. And the second point there is the in-house accountant training. So what we see in many businesses is kind of various levels of expertise in-house, and if there's any more input that's required to move some of these points forward and get your reporting to that degree, and then we can provide assistance with that. So if you want any more information on that, then please click on the link which will come up after the event is finished, or email Joe or myself, which are the contact details showing on the screen. So hopefully that's given us a key overview of what some of the trends we're seeing. Overall it's been a buoyant period, but there are some areas which have perhaps needed some concern or needed some attention, and hopefully they've been identified in the session today. So we're going to move on now to the question and answers. Now we've had some great questions come through, so please keep them coming if you've got any questions. So just looking here, what questions we've got. So there's a few questions about the slides and the recording yet, that will be available. There was one question here. Do you have any examples of less obvious direct costs that we might overlook? I don't know, Joe, have you got any thoughts on that?
Yeah, it's a really good question. What we've found is that businesses do overlook some of these costs, and they do slip below the line, or maybe even into your purchases or something like that, so that you're not able to track them so closely. So I think either way, it's important to isolate them. Some examples would be things like import duty and inbound freight. They want to be separated out from actual purchases, so at least you can look at them and track them. And then below the contribution margin line, you might say, in the direct costs, some really pertinent ones for the current moment would be storage costs. As you hold more stock, you're maybe putting stock in outside warehousing and that kind of thing, making sure all of those costs are tracked and above the line. And then you've got increased cost of energy and fuel, making sure all the drivers, if you've got vans out there delivering, making sure the vehicle expenses, the fuel, the drivers, everything related to those vans is given a target. I think it's important to set targets, would you say, and also keep to them on all of these costs. So yeah, when we send the slides through, you'll see some of the examples on there, but those are some of the ones that often get missed, we found. Would you add to that, Angus?
No, I think it's just important always to review, isn't it, all your expenses, if you like, and just see if there's anything that really should be identified as a direct cost. Maybe there's discounts that you offer, maybe there's rebates, maybe it's your hire of your forklifts and order picking equipment, commissions. Yeah, there's lots of impact it can be. I guess it's just always a question of just reviewing those expenses and think, actually, is this really a direct cost of fulfilling it? Don't forget, basically, you might say your contribution margin is an element of, or your direct, you might say your cost of goods is the cost of getting it goods to you. So that's your landed costs. And then the direct cost is really about what it costs you as a business to fulfill those sales. So just think about those elements that go in there. Hopefully that helps. Is there, see what other questions there are. Another question we sometimes get is around the import duty, like you just mentioned. Where is the correct place to record that, and should I pass the cost on to my customers? There's a question here. Joe, have you got a comment on that?
Yeah, so import duty is part of the landed cost of the product, so it should go above the contribution margin line, you might say, so it's included in that first cost of sales area. However, as I mentioned already, I think you should separate it out if possible and make sure you're tracking that. What we've seen is, particularly since the UK obviously left the EU, we've seen import duties increase, haven't we? So it's even more important to be tracking those. The other thing I would say on that is make sure you're passing that additional cost on to your customer. So if your import duty's gone up to say 10% on the goods you're bringing in, make sure that you're actually adding that onto your sale price. The other thing we might say is touch on as well is don't just accept import duties at face value. It may be worth just looking into them and making sure that they are actually correct. We have come across businesses that have been overpaying on import duty. So that's just another comment I would make as well. Thanks.
Yeah, that's good. No, that's some helpful tips there. Another question here is, what should I do if my cash flow percentage, or I guess referring to the net variable cash flow that we mentioned, is negative? finding it difficult to change customer or supplier terms, and faced with the situation of increasing stock. So I guess it is a real situation, if you like, and if you're importing, particularly obviously lead times and the need to have the stock on the shelf is pretty key. Now, if you are importing, in terms of funding that, where your cash flow is, that cash flow percentage is negative, well, one option you may have is maybe let's look at an import loan facility. Obviously, that obviously comes at a finance cost on that, but that is one option that can be looked at, so it might be worth speaking to your bank on that. However, I would say that really every business should be able to get into the situation where that cash flow percentage is positive, if it literally is fundamentally negative, then I'd say maybe we're not quite in the right business. Maybe we're not targeting quite the right customers. Maybe we need to look at some differences in our supply chain, because if your cash flow is negative, then it is very hard to grow that business, your business, without extra funding. And there's only a limit as to how much funding you can pump into something, I guess. So that probably sounds like a bit of a tall order, but I guess there isn't really any option apart from looking at what actual stock we need to service our customers, what are our credit terms we're offering, and be robust, be fearless in sticking out for the way that you do business and the way that your credit terms work. And also then on your suppliers, and I guess we have always got to balance on the suppliers what's obviously the situation that's come in recently between badgering them for extra credit terms versus obviously making sure that you actually you're on side with them and getting the stock through and getting priority service. But there might be something there. It's a partnership arrangement with your suppliers. Talk to them like that. It's a supplier partnership. If they can help you, well, you can help them, because you get the business. So that's one question. Another question here, I've got carriage outwards is often recorded as a below the line expense according to accounting tradition. Is it allowable to include this in the direct cost and therefore GP calculation instead? Any comments, Joe?
Yeah, very good question. Carriage outwards, yes, I've often seen that loaded in with the overhead costs, along with wages, motoring expenses and things, just the standard overheads. And I think we've been encouraged to make sure that's above the line. So carriage out goes above the GP line to give a true GP percentage. So that would definitely be one of the elements that is often overlooked and slips into overheads. So a really good question. Think of it as a cost of getting those goods to your customer. It's a cost of sale, really, isn't it? So it goes above the line. In my opinion, Angus, would you agree with that?
Yeah, 100% agree. No, definitely. Yes, I agree that it might be kind of accounting tradition show like that. I guess in terms of using our, our data, our figures, and our management reporting to drive our business, we sometimes have to override, you might say, accounting tradition for management purposes, and therefore we need to include that. And the other thing, just to quickly throw out, I think we did touch on it earlier, but sometimes we talk to businesses and they say, well, how you've got carrier costs, you're using external courier companies to do most of your deliveries to customers. Have you got any other? Do you ever use any of your own vehicles? And they might say, oh yes, we do have a couple of vans kicking around that every now and then we'll actually take out and do some deliveries. Or oh yeah, we've got actually a van for one of the installers that they go out and assemble something on site. Well, you need to make sure you're capturing that, because that is part of your carriage cost. If you weren't using that, you've been using an external company to do it, is part of fulfilling the cost. So yeah, very key to make sure you allow for any costs, whether it's external or internal, in delivering those goods. Good.
Another question just come in that I'd quite like to make sure we answer. concerning inflation and interest rate increases. Someone's asking, where do I record those in the management accounts? So yeah, they're very topical points, aren't they? Inflation and increasing interest rates. So just to run through that, obviously inflation automatically comes into the cost of the goods. So that will automatically come through in your direct costs. Obviously, if you've got your report set up correctly, that should be then automatically monitored, the actual versus budget, so you can see that happening. So if there's an inflationary element coming through in maybe in the cost of fuel or storage or something, it should automatically flag up. That's the whole point of setting targets for all of those percentages and then tracking them. Interest, it's a separate point. It's not a direct cost, so interest does not go in the trading account. In fact, it doesn't affect EBITDA at all. EBITDA it doesn't even go into overheads for EBITDA purposes. It falls lower below the EBITDA line, so it's just a cost of financing your business. So a couple of really good points there.
Good, thanks, Joe. And there's another couple of questions, a few questions here we can quickly answer before we wrap up. Two of them are linked. One is packaging costs going above the line, and the other one is relation to the new plastic packaging tax, which has come in from this month. Is that a direct cost? So the answer to that is yes, packaging should definitely go above the line, and the other one is any plastic packaging tax should also go above the line. So yeah, it's, if you think about it, it's the cost of you sending those goods out to your customer, and if you invest in packaging, whatever that might be, whether it's branded, whether it's labelled, or whether it's a cost of you fulfilling that order. So absolutely goes into your direct costs. And then one final question is, would you include depreciation on delivery vans as a direct cost? So I guess that relates to that what we were just talking about earlier about your own vans. Absolutely, yeah. If you've got your own vans, then include the depreciation on those as a direct cost if you can. Again, it's just all about, you never lose out by putting those direct costs above the line, and we've seen it happen in many businesses. The profound impact, you might say, of allowing for the realistic direct costs, and it changes the focus of the business, even just from a psychologically factor. You want to focus on improving that GP. So I'd encourage everyone to just bite the bullet and do that. And that depreciation, for example, realistically, if you're using an external courier company, they've got to cover their depreciation on their vans. So why shouldn't you in your costs? So good. Well, thank you everyone for those questions, and thanks everyone for joining today. It's been great to host you, and we look forward to seeing you again soon. Thank you.